What are some assets in accrual basis of the accounting? Well, recall our definition of an asset. It's things of value that you own or things that have future economic benefits. So it could be an accounts receivable. That is when you've provided a service and you've recognized revenue in advance of cash being received. You'll record revenue and you'll record accounts receivable instead of cash. Prepaid expenses is when you pay for something in advance of being able to use it, or you pay for something in advance of receiving that service. An insurance policy is a great example. Oftentimes we need to prepay an insurance policy that covers the upcoming month or the upcoming quarter. Well, you'll recognize that as a prepaid asset and then amortize that into expense over the period in which it relates. Inventory is another example of an asset. Supplies that you've acquired that you'll use in future periods. You'll record that as an asset on the balance sheet until you use that asset up. And then fixed assets. Again, similar to inventory, here you're purchasing an asset that will benefit multiple future periods. It could be a building that'll benefit potentially up to 30 or 40 periods. It could be a car that maybe you'll use for 3 or 5 years. It could be a computer that you're purchasing now and you'll use for a number of years going forward. That's an asset that you'll record on your balance sheet, and then you'll record depreciation expense as you use that fixed asset over time. And we'll look at an example of fixed asset accounting here shortly. So let's talk about some liabilities in accrual accounting. First, accounts payable, very similar to accounts receivable, but on the other side of the balance sheet. If you'd incurred an expense that you have not yet paid, you have an obligation to that vendor because they've given you a good or a service or they've provided you a service. So you'll record the expense and you'll record accounts payable that will be paid in a future year. Deferred revenue. This goes back to our membership dues example we touched upon a short while ago. If you're collecting your membership dues in January, but you're not going to earn that until February, you'll record that as a liability now, and you'll amortize that into revenue when you do earn it the following month. Notes payable or debt. These are liabilities. Remember my car loan example a few minutes ago. These are borrowings that must be repaid. And you may also have other obligations to your employees. Perhaps your employees have provided you service and you just have to pay their payroll at the end of the week, at the end of the month, or the beginning of the following quarter. That's accrued payroll that will be recognized as a liability. Or if you have a pension that they earn now because they're providing you that service, and you're agreeing to provide them pension benefits after they retire, well, that can be a pretty significant liability that many not-for-profit organizations will record. What are some key valuation concepts as you look at the balance sheet for a not-for-profit set of financial statements? Well, assets are generally recorded at the lower of cost or market value, or as we've mentioned before, net realizable value. There are some exceptions. Investments will be recorded at market value, and you can usually determine that based upon their publicly traded price. Fixed assets will be recorded based upon their original cost less their depreciation, and we'll look at that momentarily. Accounts receivable, or perhaps pledges receivable, will be recorded at net realizable value. That is, how much do you reasonably expect to receive? And we'll look at an example of that here as well. Liabilities, they'll be recorded at the amounts you expect to pay. And the key here is that you oftentimes revisit your value of your assets and liabilities, usually every time you prepare a balance sheet, to determine if changes in value need to be reflected either for new circumstances. As we know in the stock market, investment values will increase or decrease over time, and you'll need to reflect those changes. Your fixed assets will depreciate. You'll need to reflect the decrease in the value of those fixed assets. Accounts receivable, perhaps you've collected some receivables, and therefore your accounts receivable will decrease. Every time you prepare a balance sheet, you need to revisit the value of your assets and your liabilities. Capitalization versus expense. A cost that you incur can either be expensed immediately, or it can be deemed an asset, in which case it gets recorded on the balance sheet. Generally speaking, if you're purchasing a service or some type of good that's going to be used immediately in the nature of your business, you'll recognize an expense in the statement of activities. However, if you're purchasing an asset and it has future value, remember that definition of an asset, it has future value to the organization, you'll record it as an asset until it's expensed or used up in the by the organization. And as you can see, there are two general criteria that need to be met in order to record an asset. You need to have acquired some type of right, and you need to be able to measure it. So let's talk about that fixed asset example. And in this example, we say, let's purchase a computer for $10,000 today that you're going to use for 5 years. Now, I know you're probably saying, wow, what computer am I going to use for 5 years and the way technology evolves, but bear with me. So if you purchase a computer today for $10,000 and you're going to use it for 5 years, you'll record that initial asset and increase fixed assets for $10,000. Cash will be reduced because that's the cash that went out the door to purchase that computer. Over time, over 5 years, as you use that asset, you'll decrease the value of the asset and you'll recognize depreciation expense, in this case $2,000 per year, to reflect the depreciation or the use of the asset. And therefore, on your balance sheet, the net book value of your fixed assets will reflect the original cost of $10,000 less any accumulated depreciation that you've recorded. And so here it is, just numerically. In the first column, you can see that original cost to purchase the computer for $10,000. That doesn't change. However, the accumulated depreciation will steadily increase over 5 years in $2,000 increments until that asset is fully depreciated at the end of the 5-year period. And at the end of that 5 years, the net asset you have left in your balance sheet is now zero. And within your statement of activities, you'll have $2,000 of expense per year. How about debt? Debt's a frequently encountered item on the balance sheet, so let's talk a little bit about how it's accounted for. Debt includes two components. Your principal, that is the amount you've borrowed. Remember, in my example, I purchased a car for $20,000, as well as interest. Generally speaking, unless it's perhaps your mom or your dad, when you borrow money from another party, they're going to charge you interest. That is, the amount that you repay is going to be the principal plus a little bit extra based upon the interest rate that they charge you. And as you make those payments each period, some of that payment will go towards reducing the liability, and some of that payment will be recognized as interest expense. So let's look at this numerically as well. Let's pretend that we incurred debt of $50,000 and it was going to be paid over 6 years. So if we start in the first column, our opening balance of debt is at $50,000. And let's say, generally speaking, we're going to pay that debt back in $10,000 increments over the first 5 years, and then a little bit less than $10,000 in the last year. Now let's look and see how that payment is allocated between principal and expense. In this case, the interest rate on my loan is 5%. So in the first year, when I have an outstanding debt balance of $50,000 times 5%, my interest expense in that first year is $2,500. So therefore, when I pay $10,000 for the year, $7,500 of that will reduce the principal outstanding, and $2,500 will be recognized within the statement of activities. Now this is very important because remember the cash flow statement. That reduction in principal for $7,500 is a cash outflow from financing activities, whereas interest expense is a cash outflow for operating activities. And at the end of that first year, we made the $10,000 payment, but my debt balance didn't go down by that $10,000. It only went down by the reduction in principal for $7,500. So at the end of the year, my debt balance is now $42,500, which becomes my new balance at the beginning of year 2. And you'll follow that same process along as you make payments over the next 6 years. Now look and see what happens within the reduction in principal column. Although your payments generally remain flat at $10,000, ignoring the last year, the reduction in your principal grows over the course of that 5-year period. Offsetting that is a reduction of your interest expense over that same period. And the reason for that is that the outstanding balance of your indebtedness is also decreasing, and therefore the 5% rate that's being applied to that balance will similarly decrease. The net results, at the end of the 6 years, you no longer have any debt, you've paid off the $50,000, and you've incurred an interest expense of just under $9,000. We talked about estimates a little bit when we presented the balance sheet. Estimates are very important to the financial statements. Assets and liabilities are recorded at the expected ultimate realizable value. And two particular areas of estimation that we encounter in a not-for-profit set of financial statements include accounts receivable and pledges receivable. And they're very judgmental to determine the net realizable value for those financial statements. And let's look at a couple of examples. Starting with pledges receivable. Let's pretend that the organization is running a fundraising campaign, a telemarketing campaign, and 1,000 people have promised the organization that they'll each contribute $50 to the not-for-profit organization in February. However, your past experience shows that about 4% of those donors, on average, fail to make good on their obligation. So what asset are you going to record on your balance sheet? Are you going to record the full $50,000? Or are you going to record something a little bit less because that truly is the net realizable value of that asset? And that's the key. You'll recognize a gross asset for the $50,000. That's an increase to an asset and an increase to contribution revenue. But you'll also recognize bad debt expense for $2,000, $50,000 times 4%. And that will be an increase to your expense, and it will reduce that asset. So now your net asset that you've recorded within pledges receivable is only $48,000 because that's what you expect to collect. Let's look at another example. This is something that's near and dear to my heart because I spend quite a bit of my year actually working with healthcare organizations here in the Boston area, and in particular the accounting for patient accounts receivable and the judgments that go into valuing both the bad debt as well as other allowances is something that employees can spend their full year on. In fact, there are employees within the finance department of hospitals that focus solely on the valuation of patient accounts receivable. Let's look at this example. You provide service to patients that are worth approximately $100,000 that you've yet to collect. However, some patients, depending upon the nature of the insurance that they have, or perhaps that they don't have, may not be able to pay for that service that you've provided. The thing is, with a hospital, if someone comes into the emergency room and needs medical attention, you can't really ask if they have the ability to pay before you provide that service. You're going to provide that medical care regardless of whether they can provide that service. Therefore, it becomes important to determine how much are you truly going to collect. So here, again, are you going to record the full $100,000 as asset and revenue, or something perhaps a little bit less? Similar to the pledge example, in this case, the hospital's experience has shown that approximately 25% of the charges do not get collected. And believe me, that percentage is actually quite low. On average, on gross charges within a hospital, it could be upwards of 40 or 50% of gross charges go uncollected. But in this example, let's say 25%. You'll record a gross accounts receivable for $100,000, less an allowance for uncollectible for 25% or $25,000, such that the net AR that you recognize as an asset on your balance sheet will be $75,000. You'll still have $100,000 of revenue, but you'll also have $25,000 of an expense running through your statement of activities. And each period in which you present your balance sheet, you'll need to revisit the value of your patient AR as well as the value of your pledge receivable, because that 25% collection factor in this example may change from period to period, and therefore you may need to adjust the value of that asset accordingly. What about footnotes? We haven't talked about footnotes very much recently, but an instrumental part of a set of financial statements. We've talked about the balance sheet, the statement of activities, the statement of cash flows. When you look at a set of financial statements that have been prepared in accordance with GAAP, at the bottom of that set of financial statements, it'll always say It'll always direct the reader to the financial statements. It'll indicate that the financial statements are an essential part of the footnotes are an essential part of the financial statements, and the reader should pay attention to them. And just as an advance warning, as we get into Module 2 and we talk about our case study for Pilgrim Service to Society, I do encourage and remind you to focus on those footnotes of the financial statements. What's going to be included in those footnotes? It's going to have detail on what accounting policies the organization follows. It's going to have detail on the financial statement components. So for example, if you have one line item on the financial statements that says fixed assets, well, within the footnotes, you'll have a detailed chart that says how much of those fixed assets may represent buildings versus land versus computers versus other asset categories. Similarly, for debt, you may show one line item on the financial statements for debt, or perhaps two if you have a current portion of debt that's going to be paid within the upcoming year. But the debt footnote will have a lot more detailed information on over what period of time will that debt be repaid. Do you have significant payments that are coming due within a year or two? What interest rate are you paying interest on with respect to that debt? And other important information. And then there may be other important financial matters that can't be yet quantified but are disclosed in the financial statements, such as significant uncertainties, contingencies, or other estimates. Perhaps the organization is involved with a particular legal case for which you really can't yet estimate if you have an obligation. But there may be some detail in the footnotes to take a look at that would give the reader of those financial statements the indication that there is some type of a legal event going on. Audited financial statements and those statements that are produced for the external public are required to contain such financial statement footnotes. So on the next few slides, I won't go through in detail, but I do acknowledge that we've covered quite a bit of ground here in this pre-module, and that reading a set of financial statements takes time. It takes practice. I've worked for a public accounting firm for now 20 years. I've had a lot of practice in reading financial statements, but it takes time. I encourage you, after the conclusion of our module, to look at your organization's own financial statements, or go online and track down the financial statements of another organization and familiarize yourself with the concepts and the principles we've covered in this over the past hour. It's a lot of information. However, this slide and the next two that follow will provide you some Cliff Notes version, if you will, of some key information you should keep in mind as you look at those financial statements, including some key questions to ask when you're looking at the balance sheet, when you're looking at the statement of activities, some questions to ask with respect to the cash flows, as well as those important notes to the financial statements. So we've covered a lot of ground in the pre-module, and I appreciate your sticking with us. Let's look ahead as to where we're going from here. We're about to begin the 4 modules within not-for-profit financial stewardship. Professor Honan will take you through the first module, focused on mission, money, and impact, and I'll come back and join you for modules 2 and 3, in which we dive into some more complex aspects of financial statement analysis, as well as the tools management uses to conduct such analysis. And then Professor Honan will round out the course and talk about budgeting and resource allocation in modules 4. I welcome your robust exchange, your discussion board activity. Please come prepared to the live sessions and the office hours to have a lot of great interactive dialogue. Let's make this program as interactive as possible. It'll be beneficial for your fellow participants, and we'll enjoy our time together. So thank you very much for participating in the pre-module, and we'll see you shortly.